Welcome back to the Dividend Diplomats YouTube channel, everyone. You got your boys here, Lanny and Bert. Dividend Diplomats, hey.
You guys, hey.
So what we're talking about today in this video right here, right now, we're going to talk about two credit card stocks that just released their earnings, and we're going to share our thoughts about them. Are they a sign of tougher things to come in the economy? Or is there some great news buried in there? And then lastly, are they both stocks to buy today? Let's go.
Guys, before we dive in, make sure to smash that subscribe button. We're almost at 20,000. Actually, we got to get to 18,000 first. So let's get there, guys. Make sure to hit that red subscribe button, that notification bell, and like the living piss out of this video, guys, because we're the Dividend Diplomats, and we are here now and forever, baby. Let's go, Bert. You got two stocks here in the payment processing industry. A little bit of volatility happened towards the end of this week here that ended July 21st. One stock was down significantly.
Yeah, we're talking Discover Financial, ticker symbol DFS, and American Express, ticker symbol AXP. So these two stocks are a little bit different than Visa and MasterCard, which is why we're leaving them out there. Sure, Visa and MasterCard are the two largest. They're the largest credit card processors out there. There's no doubt about that. But what makes Discover and American Express fundamentally different from those two is they hold loans on their balance sheet. So that is why they are different than the other two. Discover has a large portfolio of credit card loans, consumer loans, and student loans. They have a student loan portfolio buried in there, while American Express has almost the exact same thing. So you don't just worry about their fees, their interchange fees on their income statement. You also get to talk about loans, the performance of the loans, the provisions and everything. So that's what's exciting. And that's what came out when both companies released earnings this week. So that's what was fun. That was the big thing. And what happened to Discover after those earnings releases, Lanny?
Well, Discover, obviously the stock fell over 10% plus. I think at one point, maybe 14% after they missed the estimates for their latest quarter, guys. They had a revenue and EPS miss. Now, the big thing is because they hold credit card balances on their balance sheet, an institution's not holding it, Discover is holding that debt. The delinquency rates are creeping up. No surprise there as the U.S. economy continues to spend money, this time maxing out credit cards. Credit cards is, I think, what, Bert, almost at a near all-time or at an all-time high of balance now.
Yeah, they said closing in over $1 trillion there. I mean, the consumer continues to spend despite potential warning signs besides record high inflation. And I think you hit the nail on the head right there with the performance. The loans grew 19% year over year. So loans for Discover are almost at $120 billion now. Credit card loans themselves are at $94 billion there. So think about that for Discover for a second. If we said credit cards getting towards $1 trillion, Discover owns 94 billion. That is nearly 10% of it is right there sitting on Discover's balance sheet. So if there's a shock to the economy, there's a major shock to performance of credit card loans, Discover is going to feel it and feel it pretty heavily. They said and when you're looking at the performance, you look at how are the loans performing, you look at what loans are becoming delinquent, as in what number of people miss their payments. So if it's 30 days delinquent, that means what percentage of the portfolio are people that haven't paid their credit card in 30 days. That number is up 110 basis points year over year, up 10 basis points from the quarter. It's now 2.86%. And then people that were they just write off the loans, that one is up to 3.22%, which is 142 basis higher than the previous year. So credit card performance is starting to get back to the historical levels of where you saw it back in the day. So it's definitely on the rise.
Right. Yeah. I mean, and with that, obviously, Discover has to record provision for the loan loss through their probably expected credit loss model. And, they recorded about 1.3 billion, which, I hate to say it, but it was pretty much double what it was last year. So that caused a significant impact to earnings, which caused a significant impact to them missing estimates, with them obviously whiffing and their stock price tumbling. So that's what happened with Discover Financial. Again, ticker symbol is DFS, and they finished off at $105.11 on July 21st.
Yeah. And again, it's not all doom and gloom. We're just saying these are what the facts are telling us. The facts are telling us Discover's preparing for more credit card losses. Discover's preparing for a tightening economy and worse performance. So that's really what you're seeing in there. Let's take it to American Express is then there, because American Express has a slightly different kind of story than Discover. They saw declining earnings, so they had a smaller than expected profit. They are showing signs of slower revenue growth there. But what was different for American Express versus Discover is they said, despite all of this, we're still maintaining our earnings per share estimates. We're still expecting revenue to grow 15% to 17%. We're still expecting EPS of $11 to $11.40. And they performed well too on top of that. Earnings per share still topped the consensus. The 289 earnings per share topped consensus estimate. Revenue was still over 15 billion, climbing from the previous time. So despite potential slowdowns in what you're seeing from American Express, their earnings didn't miss like Discover. They still crushed it from a financial perspective.
Yeah, and I know there's discussion about American Express taking over the Apple call it accounts from Marcus. So keep your ears glued to the news feeds for that. The loans as well crossed over 100 billion. That's close to 115 billion now on credit card, loans on American Express's balance sheet. And similar to Discover, they recorded about a 2% net charge off amount, which was more than double where it was last year, similar to Discover. So you're seeing similar trends, an increase from last quarter and then a significant increase from the same period last year. But again, hey, that's going to happen. That's natural. That's cyclical. In any normal time period where debt is rising, charge-offs will rise. That's just the nature of the gambit.
So let's see how the valuations are going to play out here. Because sure, we just talked about earnings and we just threw a lot of numbers at you. But now let's actually look at the numbers here. We're going to run them through our screener, which has three metrics and a bonus metric: PE ratio less than the S&P 500, payout ratio less than 60%, history of increasing dividends, and then lastly, that bonus metric, the dividend yield. So let's see, are they both stocks to buy right now? Is one a cheaper value than the other one right now? What are going on with the numbers? Let's do Discover first, and then we'll come back to American Express. Lan, you want to kick us off with Discover?
Yeah, let's put the pen to paper here, guys, to see if these are two possible stocks to buy, two stocks that if you own, you should hold, or maybe you're interested in selling them after the big drop, at least from Discover. Yeah, $105.11 is where Discover was recently trading at on July 21st, guys. So big DFS here. And their expected earnings, though, based on analysts, is $12.96. Do the math, a very low price to earnings ratio. Anytime you see the first two digits is greater than the stock price is two digits, know that that's going to be below 10. So it's 8.11 times future earnings. So the S&P 500 obviously is trading at 25, 26 times current earnings. So wow, price to earnings ratio is very low here comparatively. And we'll look at American Express afterwards and see how it stacks up.
Yeah, so their annual dividend is $2.80. That gives you a really low payout ratio of 21.60%, which is great because if we talk about some of the headwinds they're facing, you might see some earning pressure on earnings. You don't necessarily have to worry about the dividend right now because there's so much room to continue paying, maintaining, and even growing that dividend. Even if earnings drop 50%, it's still below 50% on the payout ratio front.
Yeah. Great payout ratio, which leads to a great dividend growth rate. Over the last 12 plus years, they've been increasing dividends. That average dividend growth rate, again, this is a passive income juicer right here. The 5-year dividend growth rate on average is 12.30%. And, if we just take a quick look, diving into the dividend history of Discover Financial Services, I know they recently increased their dividend, not by 5%, not by 10%, but they actually went from 60 cents to 70 cents. So guys, we're talking a 16.67% increase that they announced back in April of this year. So what does management think about what's going on? They're like, hey, credit card balances are up. Credit card income will go up. We are going to be just fine. Our balances will be just fine. Payout ratio is just fine. So let's increase our dividend higher than what we usually do. And that is beautiful to me.
Yeah. And now their yield is at 2.66%, which is above their 5-year average yield of 2.29% there. So another potential undervaluation sign. And performance wise, this last week after they got crushed by earnings, down 11.13% over the last 5 days. Still year to date, though, they are up 8.37% this year and up 5% over the last 52 weeks. So that's Discover right there. Significantly discounted compared to the market. Payout ratios low. Strong history of increasing dividends and a nice yield that is above the S&P 500.
Guys, that's Discover. Let's go into American Express. Cha-ching, one of the original credit card players here, guys. AXP is the ticker symbol. Trading at $170.22, Bert. And analysts are expecting $11.06. So you already know the price to earnings ratio is going to be higher than Discover's, and it is. It's at 15.39 times earnings, which is almost double Discover's PE ratio.
Wow, that's all I can really say about that. So let's see how the rest of the metrics are. Their annual dividends 2.40%. They also have a 21% payout ratio. They're about the same. They're almost identical payouts. Moving to the dividend history, though, their 5-year average dividend growth rate's 9.86%, but they've only increased that dividend for 1 year, though, because at the onset of the pandemic, they paused their dividend hikes, and then they waited a year, and then they just started resuming it again. So they had to restart that dividend growth history streak that they were building prior to the pandemic, but is going.
Yeah, AXP said, hold up, wait a minute. But hey, that last increase, that's why their dividend growth rate on average is lower, because that includes a 0%er as well in the mix. The last increase that they did announce was 15.4% of an increase. So they're back, baby.
Yeah, their yield is 1.41%, which is a hair above their 5-year average yield of 1.32%. So it's a little bit below the S&P 500. Discover was above, American Express is below. Interesting.
And they were down in the last 5 days, 2.68%, and they're up almost 16% this year and up 11% since last year. So, in a nutshell, I think you got a little bit more volatility with Discover. Obviously, you could say risk to reward, right? A little bit more of a risk with Discover, but you might be getting a little bit more of a reward from a current yield, and maybe a current dividend growth rate could be higher.
Yeah, I very much agree. And I'm not going to be watching American Express right now, just looking at the two of them. The metrics just aren't there for me. It's a great card. I love the American Express card I have. I'm not going to complain about it. They're doing some great things. Getting the Apple business from Marcus would be huge, and they're delivered on strong results. There's nothing about that. But from a pure value standpoint, you can't argue about how much more of a discount Discover is. People, to your point, Lanny, there's a reason why. There's going to be some more volatility from there. But I'll keep watching Discover right now. And if that yield ever comes close to 3%, say something happens where the price falls down from there, maybe happy to add one or two, but this is one to watch, especially as more economic news continues to come out. There's going to be some volatility there for Discover.
Yeah, keep your eyes on Discover, guys. Bert's probably looking at somewhere in the 90s then on the, stock price of Discover. Let us know in the comments, do you own Discover Financial Services, American Express, or Visa or MasterCard? Let us know. Let us know also what's your favorite card in your wallet. Is it a Visa, Master, American Express, or a Discover card? I know Discover's got their 5% back category plus the doubling of your points or something like that in the first year. So let us know what's your favorite card in the comments below. For, obviously the subscribers here need to keep pursuing financial freedom, keep staying invested. What about all the other non-subscribers?
They need to realize that if they're not with us, they're against us.
Oh boy.
Yeah.
Guys.
Let's send us out of here, Lanny. Let's get out of here. All those
That was Bert and Lanny from the Dividend Diplomats. Over and out.